calculation, you're working in a piece of paper, all right? And then you screenshot or you take a photo of that attachment of that paper, and then you put the attachment in the slot provided for that particular question. All right. So don't forget to put your names and also matrix number on each paper that you use. All right. So example, you have a piece of paper, right? Okay. And then you do the first page, and then you go and do the other page as well. Okay. Both sides. So both side of the paper, you need to put your name, jot down your name, and also your student ID, your matrix number. And when you uploaded the attachment, please rename the attachment with your name and also matrix number. I'm going to put the apa tu? I'm going to put the apa tu, the sample on how you should rename or name your attachment later on in this section. So tomorrow, when the time comes, please be ready at least half an hour before the exam. Ready means that you ready take your breakfast, ready have a shower and prepare, have your own table, okay? Set yourself away from all the noises, everything, okay? Make sure that the area is convenient enough for you to do the exam, okay? Then apa tu at 9 so what time? Oh, 9:30. By 9 lah you should prepare yourself, okay? Wake up everything, and at 9:30 a.m. then I'm going to make available the links. So where can you get the links? You go to your elite. This is your elite page. Okay, I'm going to make it available here. Okay, actually the question is available, but I have not make it available to view for the student yet. All right. So everybody will receive the same set of question. All right. 20 MCQ question and also one short answer question. But the difference is because the question will be shuffled. Okay, so when you start off with the exam, the first question that you get is not the same as what your friends are getting. Right, but everybody will receive the same set of question. Only maybe you are attempting question number 1, but your friends are doing question number whatever. All right, so the sequence of the question is not necessarily the first question coming from the introduction to corporate finance, then risk and return. But then because I set the question to shuffle, all right, it will be jumbled up lah. Okay, some of you might have the question from the valuation of common stock first, and then go to the capital budgeting, and then go to the capital asset pricing model, and go on. All right, it doesn't necessarily it will go in sequence. All right, so don't expect that you will get the question to be in sequence. But then maybe for midterm exam, usually, okay, if we have this like face-to-face, it's luckily that we opt for online actually, because okay, because of the holiday, right? The midterm breaks are coming, and then the week after that, okay, lots of other courses are going to do the midterm exam face to face, physical midterm exam, and we are facing with the the constraint on the venue, right? Most of the exam need to be done during the night time, which is I don't like it at all. I don't like any exam to be on the night time. Okay, on the night time during the weekdays. Okay, usually we can use Saturday, all right, and Sunday sometimes for midterm exam, but there is an instruction coming from the upper management university saying that students are not allowed, or the management or the faculty, the lecturers are not allowed to conduct any exam on Friday, starting Friday night, Saturday and Sunday. So we are all racing with each other, okay, all the lecturer racing with each other to set up when would be our midterm exam. All right. I'm having a difficulty with my other class, okay, because that one is other course actually, because that one we have 5 instructor for a larger group, managerial finance, which was taken by other program this semester. So we have a very huge group, almost 500 students, all right, and we are finding it difficult to find the placement, the venue, right, to do the exam. But luckily for my corporate finance, I already make it clear from the beginning that we are going to have it online. Hopefully everybody are feeling the same as me lah. Nobody is saying that actually you prefer to have a face to face. So for the face to face exam, we wait until the final examination. All right. So yes, now because of the short answer question, okay, it can come up like what I mentioned to you just now. It can come up early as question number 1, okay. So my advice is, if you look at the timing, it's 2 hours, right? Some says like 2 hours, 20 MCQ, 1 short answer question, or you have ample time. But you need to do or strategize on how you go and attempt the question, all right? So because the short answer question, you need to do the working. I mean, to do some work lah, using your handwriting, working. All right. Don't type your answer. Okay, everything need to be using your handwritten. So you do your working, all right? You take the photo and then you need to make sure that you attach, and the attachment is in the system. So it took a while, right? Although many of you say, oh, it's just like a few seconds, a few minutes to get it done. But then, okay, my advice is, when the link is open, okay, once you start click, if possible, do this short answer question first. Okay, because it needed some time for you to do the working and also to do the attachment, to make sure that the attachment are in the system. So when you click the start button, I set the question to be in one page. The whole question will be in one page. You don't need to go back and forth. The only thing that you do is just to scroll up and down. All right, up and down, up and down. All right, if you select the answer, or if you did not really sure the answer of MCQ, then you can skip and then come back later. All right, but my advice is for you to do the short answer question first, so that if you find any difficulty or in terms of like timing, not difficulty but the time constraint, okay, I don't want you to wait until the last minute, and then when the time's up, you cannot go and attach your attachment. That there's no extra time will be provided for you to go and put your attachment. That 2 hours is enough. All right, I purposely structure the question and carefully thought about the timing. All right, so the 2 hours include the time for you to do the attachment. All right, I set the quiz to be automatically be submitted. Okay, once the time's up, once it reach 11:30 a.m., no matter you click the submit button or you did not click the submit button, your quiz will automatically be submitted without attachment lah. If you did not put attachment earlier, so it will be automatically submitted without your attachment. But if you have put your attachment in the system, then it will submitted with your attachment. Do I make myself clear?
Yes, madam.
All right.
I want to
Okay.
ask the attachment for the sub question with handwriting, right? Then
Yes.
then is it we submit in that page in the what? The midterm page quiz
Yes,
form?
yes. In the quiz function, I'll make it available a section after the quiz after the question for the short answer question. Down there is a link for you to put the attachment.
Oh,
It's
so we
together.
didn't
It's
have
not
the
the
extra
separate
link
link.
to submit lah.
Yes, that's why I said it must be submitted within that 2 hours. There is no separate link for you to go and do the attachment for the short answer.
Oh, okay. In
Mm.
the MCQ's question is like the normal, like we choose one answer in the elite lah, like
For
the
the MCQ, yeah, ABC.
oh. So
MCQ
the ABC
multiple
is not
choice.
handwriting lah.
No, 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 no.
Just
The
the
only
just the
handwriting is the short answer, yes.
okay. Okay, sure.
All right.
Understand.
Thank you for the question, Karen. Any more question? How's the preparation at the time being? Okay ke? Right, for the online class, we only can ask okay ke tak okay ke because everybody is not opening the video, the camera kan. So in the classroom, I can read from your reaction whether, although that you're not saying anything, but you need some more explanation. Yes, who's asking? Hi. Anybody asking just now? I heard somebody are calling, but I'm still talking at that time. Okay. All right. So any question? So far? Okay. All right. No question regarding this. All right. Yeah, the question is here already, but I have not make it available to the student. Okay. All right. Second question is sorry. The second announcement is regarding, okay, now we have this online class, right? So we probably going to have another online class, okay, on week 10, if not mistaken, because I was scheduled to go somewhere, all right, during that week, but I haven't get the confirmation of the date yet. But we're going to have another online class on week 10, if not mistaken. So we're going to discuss regarding that once the semester commence lah. On the third, right? Second, third, fifth. On the 5th of December when you come back to campus, right? So that is the second one. Forgotten about the third one. Okay. Never mind. So how are you? How is it doing? How are you going on with your assignment, group assignment? I received a lot of question over the weeks. In WhatsApp, in email, asking for clarification. So how is it so far? Okay ke? Ada any question that you want to ask regarding the group assignment before we go on with the learning unit? How far away are you from completing the group assignment? 50% done? Or you have at least complete the try and error and now you already pick the efficient frontier that you're going to report? Alright, okay. So let us look at the submission date. Okay, so the deadline for this assignment is on the 9th of December. Right, 9th of December, most probably like in 2 weeks' time. All right, and be reminded that on the 9th of December is the submission for two things, which is the report and also the video presentation. So if you can finish up with the report earlier, then you can concentrate on doing the video presentation. All right, and for the video presentation, I'm going to prepare a submission through Padlet. Okay, I'm going to prepare the link later on down here. Okay, make sure that you complete the report as soon as possible, because I believe that making the video presentation is a bit hard because you are, even though you are at the same, I would say, if you come back from the from the holiday, right, from the break, you have at least 1 week for you to gather and do the presentation, right, to prepare the presentation. But then it still take a lot of work for you to complete it. All right. So please plan your time wisely. Okay, I believe that today is the last week kan, before you head on for your holiday kan, your midterm break. So most probably you want to settle the bigger portion. If you need to do discussion, the last minute discussion, you do it by today, and then next week you just embark on or just do your task and then complete it. And then you can combine all the works and prepare the report and focus on the presentation later on. All right. So that's about the two announcement. I forgotten another one. If it's, yeah, already make, yeah. Right. So for today, okay, we're going straight to our learning units, and the learning units that we're going to cover today is learning unit 7. All right. So let me make available the slide. Okay. I forgotten to make it available yesterday. Some of the students from yesterday class already asked me, okay, because they want to start doing the revision already. All right, can you see my slide? Is it clear on your side?
Yes, madam.
Okay, all right. So we're going to go about and do the discussion on the value of common stock. Okay, there are some things that is different. Okay, the new knowledge that you're going to learn today as compared to the one that you have go through during your managerial finance class. If you look back to your notes, okay, for the managerial finance, the topic that is covered for this is the same, the value of common stock. All right, the valuation on common stock. So it's talking about the same thing. But what is different between the one that you learn in your managerial finance class and also corporate finance class? Okay, we're going to look it in detail afterwards. So basically, when we talk about valuation or to find a value of common stock, we are going to use the concept from the time value of money. All right, from the financial mathematics that you learn from managerial finance. That is the fundamental knowledge that you have to know before we go on with the valuation. All right, valuation technique, present value calculation, time value of money. Basically, it's time value of money. So we will talk about value, finding a value of any investment, finding a value of any asset, finding a value of any financial asset, a real asset. Okay, we are doing or computing. Okay, from the value that we have in future. All right, what we have in future, what we are expected to have in the future to the current time. All right, we bring everything from the future and we bring it today. So when we were saying about valuation, okay, which concept do you think that we are going to use? Whether we are going to use the compounding concept or discounting concept? Which one from the time value of money? Anybody? Ada? Are we going to use a compounding concept or are we going to use a apa tu? Are we going to use a discounting concept? So which one are we using when we are talking about finding a value?
Discounting.
Discounting, yes. All right, thank you, Alia. Discounting, okay, because the hints that I've given to you just now is we already know the future value. Not to say that we know it exactly, okay? We know, not to say that we know it for certain, but we already have some expectation. All right, the probability of the cash flow in the future. So if we have something that we probably know in future and we wanted to see how or how much is that the value in the future worth at the current time, we are actually discounting the value. All right, so we're going to use a discounting concept. So any valuation, all right, in any asset, whether it's a real asset, whether it's a financial asset, whether it's valuing a house, when we are saying that we are finding a value of something, we are actually discounting, finding the value of the property, for example, okay, or the financial asset in the future, some proxies that we use, okay, and then we discount the value to find it what is the worth of that particular asset investment, all right, in today's term. So when you're doing this type of question, okay, valuation, it's really important for you to set your time. So for me, I always say timeline is important, right? Draw your timeline. Keep on repeating it again and again, how important is having a timeline. All right, drawing a timeline. So when we talk about value again, okay, so you learn about the difference, okay, between the value and the price. All right, the value and the price can be at the same value, okay. So when you observe that the value of the security and the price of the security is at the same value, we are saying that they are at equilibrium. Alright, pada titik yang sama, seimbang, equilibrium. But then if you find the value and the price at the different value, all right, at the different amount, we learn from finding the overvalue or undervalue stock previously using the security market line, right? So we already know the exact value, which is the intrinsic value. When we impose or use the calculation to find the exact value of that particular security, then we can compare the one that we observe on the exchange, because as we all know that common stock is traded on the exchange, right? So then we know that whether that particular securities is overvalued or undervalued, then we can go and do the next step, whether to buy or sell the security. So it is important for you to note that there is difference between the value and the price. But in equilibrium, price and value are the same. All right. So the price quoted in the Bursa Malaysia, all right, if you do the calculation, okay, you finding the intrinsic value, which is the real value when you do the calculation imposing the formula, right? You know the formula, what formula to be used when you are evaluating common stock, and then you put in all the numbers, all right, the variable in that calculation, and you find that the value is different from the one is quoted in Bursa Malaysia. So the price is different. So why is this happening? Because the price, as you know, in the Bursa Malaysia was influenced by many factors. The past few weeks, the price of the securities traded in Bursa Malaysia was influenced by the election. All right, the influence by the news from the election. Okay, we are seeing that lots of red counters. Red counters mean like performance are poor. All right, going downward. The price is going down. Okay, not as high as previously. The red counter mean like the performance is poor. But then starting to yesterday, all right, when the rumors regarding the apa tu, who's going to be the new prime minister, okay, congratulations to us. We have our new prime minister already, our 10th prime minister, sort of last yesterday 5 o'clock yesterday. 5 o'clock p.m. yesterday. So we can observe that the market, okay, the stock market from yesterday, since yesterday, even before the ceremony, all right, the apa, angkat sumpah ceremony, we can see that the counter in Bursa Malaysia are start having a good performance indicator, turning green, all right, and as the market opened this morning, okay, so we can see that that momentum of performance is still on a good side lah. Okay, hopefully until the weeks to come, until the end of the year, we can observe the same behavior. All right. So bear in mind when we talk about value and the price, it can be at the same amount, it can be at the same figure. All right, but then it can also be at not the same figure, because what is on in the market in Bursa Malaysia, all right, is different because it was influenced by other factors. All right, it's not just necessarily depends on the factors that is basically underlying the fundamental of the performance of the company. The one that we do, finding the intrinsic value, is we use the information of the company itself, the risk factor from the production, from the operation, from the risk associated with having that investment, having that operation. All right, manufacturing operation, like what is the risk factor of that operation? Maybe coming from the the equipment not working. Already quantify that, and then we value it, and we find the intrinsic value. All right, the fundamental value from the financial data of a company. But the pricing that is quoted, that is traded in Bursa Malaysia, was exposed to many other factors. So there is a difference between the price and the value, right? So the topic covered today, okay, will be how common stock are traded. So I'm not going to put an extra discussion on this, because everybody know that for a common stock, it was traded on the exchange. And in Malaysia, our exchange is Bursa Malaysia. And in that exchange, we have several index. And the main index is referring to the KLCI Bursa Malaysia. Unlike in the US, we have Standard & Poor and other. All right. So how common stock are valued? This is the one that we're going to put attention. Okay. Although that the start of discussion have been made when you did your managerial finance class, but then we're going to see what is different between the one that you have learned before. There's not much different actually, just a fundamental concept. Okay, the assumption, I mean, not the concept. The concept are still the same. We are going to use the discounting concept, but the one that I'm talking about is the assumption used when you do the valuation. All right, anything that we do, okay, any valuation that we do, even anything that we do in life, there are a basis of assumption that we do, right? For example, even when we want to use the CAPM formula, what is the assumption? The assumption is just one risk factor. All right. If you want to go to the airport, okay, because we are in Samarahan, I am in Samarahan. If I need to catch a plane in the Kuching International Airport from Samarahan to the airport, I need to assume or anticipate. Okay, what are the assumption? I assume that that the road is clear. So what time should I leave my home? All right, so that based on assumption. So the second point here, okay, on how the common stock are valued is based on the assumption. Okay, previously when you do the managerial finance, what is the assumption that you use? And now when we are in the corporate finance, we going to see, okay, if we change the assumption, what would happen to the value of the stock? All right. The next one is estimating the cost of equity capital. So I'm been talking about this over and over again since since we did the learning unit 2 risk. All right. But we talk about cost of equity capital. There are many ways for you to estimate the cost of equity capital, and we're going to use that again in here because when we talk about valuation on common stock, we are putting our focus on common stock or equity. So when we want to value equity, so the discounting rate, of course, coming from the required rate of return on equity. All right, return on equity. So when we are going to use return on equity, as the discounting, okay, cost of equity capital, all right, to discount the value, all right. So the discussion is again touch on this part. But I believe that at this time, at this moment, at the time that we discuss this topic, you already have some knowledge. Okay, when I ask you to calculate cost of equity capital, you already know that cost of equity capital can be calculated through CAPM formula. It can be calculated using the bond yield plus formula. There are other formula that you can use. Basically depends on the variable that was given in the question. Right? And this one is something new, the link between the stock price and earning per share. All right, this is new. Okay, we didn't do this discussion in detail during the managerial finance. Basically, when we want to find the stock price or the stock value, we use the data or the information from the dividends and the return and also the growth, and we estimate the pricing. But then, okay, there is a link between if you have the information about the earning per share of a corporation, you can actually use the information to find the value of the stock price. Right? And then the last bit is valuing a business by discounted cash flow. Okay, remember for a corporation, okay, it doesn't necessarily that sorry, I'm going to make the discussion one step back. Okay, now for a corporation, okay, we have two type of corporation. Another one type of corporation giving out dividend. The other type of corporation did not give out their dividends. All right. So previously, when you learn about valuing a common stock, we need the estimation or information about dividend. Then we can use the constant growth formula, correct? Constant growth formula to do the valuation. But then what happened if the corporation did not give out any dividend? All right. Those corporation that give out dividends, we can say that that particular corporation is still in the growth phase. Right? And those who did not giving dividends, meaning that having sorry, I'm hearing things actually. I'm doing the class at home because the internet at the office is not that good. Okay, because they changed something on in my wing. So starting from I came back last Tuesday, the internet is not that good, so I opt to do the class at home. But then I'm hearing things. Maybe somebody is like inspecting outside. I'm not sure, right? So there is a difference between the corporation that give out dividends and did not give out dividend. We're going to look at the discussion again. right? At the end of this topic. So this part here, okay, in terms of like where the common stock trader, you already learn about the primary market, the secondary market, you already learn about the common stock. So for this part here, in terms of ownership, okay, we're going to do the discussion in details after the midterm break, okay, when we are transitioning between the investment decision to financing decision, there are a bit of discussion on to strengthen about in terms of ownership. All right, we all know that when you do investment, okay, you buy a share of a corporation, you are actually one of the investor, one of the shareholder. All right, but it depends on how much that you buy lah, how much do you hold a particular corporation's shares that make you as important investor or not as important investor. But ownership shares in a publicly held corporation, when you hold a common stock, you are a owner, one of the owner of that particular company lah. You can say that if you have like even 100 lot, one lot of shares, in one lot of shares, in when you do the investment, okay, is containing like 100 shares kan. So you can do the calculation from there. If you have one lot, you still an owner, but how important are you to give your say in the direction and also the operation of that particular company, right? So this is the information that you learn about the electronic communication network, exchange traded fund, all right? But then the one that I'm going to go about is this one. All right. So when you want to do investment, okay, you need to open up another account. Okay, you can't use saving account to do investment. All right. You need to open up another account. We call it investment account. Okay, CDS account. Okay, Central Depository System account. That is the specific account for you to go and do investment, buying and selling shares. So here, listed here is the investment banks in Malaysia. There are more. I think it's about 21 of them, but then it's only 15 here because this is considered as the best performance lah in terms of investment bank in 2021, if I'm mistaken. Okay, we have previously, okay, in terms of like doing trading investment, only being parked under a bank. All right, we have apa tu commercial bank, okay, that in charge of the banking and saving, all right, the deposit and withdrawal of cash, and also one wing under that particular banks also in charge of the investment. All right, for example, Affin Bank, we have M Bank, Maybank. Okay, this one is not under a bank. Okay, Malacca Securities. Okay, RHB is under bank. So investment bank or investment institution not necessarily park under a bank. It can stand alone as well. So you go and find the investment bank for you to open up your CDS account. I think 18 years old already eligible for you to go and get your CDS account to start on doing trading, buying and sell. So if let's say you open up your CDS account with Maybank, then they give you the form for you to fill in, and then for that purpose you need to pay $10, tak silap saya, RM10 untuk you open out your CDS account, and they provide you with the apps that you can store in your phone, and with the Maybank apps, then you have information regarding the performance of the stock, okay, and then from there you can go and start buying the stock that you prefer, and then monitoring the performance, and then you can also sell off the stock that you hold using that apps as well. All right. So now the question is, I have one question coming from the previous class. Okay, how do we choose, okay, in terms of investment bank that we wanted to go and start our investment? The first one is looking at the fees, okay, the service fees are provided by the investment bank. Maybe when your capital is low, then you start off with the one that provide you with the lowest fee lah. All right, service fees. Previously, when we have this fintech open day, we have one investment bank, which is RHB, and during that time, they provide free of charge CDS account opening. All right, for this one. So in terms of like opening investment bank account, it's like your saving account as well. You can have saving in lots of banks. All right, but then um it doesn't fit the purpose, right? If you have like your money scattered, like if you have 3 banks, I think it's considered okay. But if you have lots of banks, then your money would be scattered around, and there's a burden of you paying the fees, every yearly fees for holding the account in that particular bank, right? So same concept as investment bank. Okay, having one or two is enough lah. Okay, you maybe want to trade with Maybank and one more maybe with satu lagi, the lowest one fees is Malacca Security maybe. Alright, so one or two is enough. So this is where you can go and do the buying and selling of the stock lah that you wanted to hold on, right? So you don't need a broker. Okay, the investment bank is actually acting like a broker, an online broker for you. And we have others, right? If you don't want to use this investment bank, okay, we have a platform. We call it Robo Advisor. All right, Robo Advisor platform. We have Rais, we have Wahid, and other things. Such a way, all right, for you to do your investment. Right? So how common stock are traded? Are valued, sorry. How common stock are valued? So basically, okay, because we are finding the value, we know that we are going to use the present value calculation, whereby we discount the value what we have in future to the amount today. All right, to see what is the amount today. So what is the variable that you need to go about and have before you start off with the valuation? So in here, it already state that we need the value of the dividends if it's a dividend paying stock, a dividend paying company. Bear in mind there are also a company that did not pay dividends, so there would be another way of evaluating it. Alright, so the value of any stock is the present value of its future cash flow. So what type of cash flow? Okay, what type of cash flow? So it depends on what type of investment, what type of asset that you are evaluating. Right now we are evaluating a stock, so the cash flow that we talk about here is the dividend. Alright, this reflect the DCF. DCF can be dividend cash flow model ataupun discounted cash flow model formula. Dividend represent the future cash flow of the firm. Alright, so this is how when we put it in the mathematical punya sentence lah, not sentence, equation, I would say. Present value of stock, whereby it is the price or value of a stock, is a function of the present value of expected future dividends. Dividend that is expected to be paid in future. But think again. Alright, think again. When we talk about dividends, and dividends are to be paid next year in the future. Alright, so forecasting dividend at year 1 is possible for me. Forecasting dividend at year 2 still possible. 3, 4, and forward, as the probability of your forecasting is not accurate is high. Right? So that's why we use this constant growth model when we go on valuing a stock previously. Alright, because there is high possibilities that your prediction is not correct. Right? Future dividends. Right? We have an example here. Okay. When we want to calculate, okay, when we want to value a stock, the cash flow is coming from dividends, and then we going to use constant growth formula. So another variable that we need to know is return on equity, because this is equity capital, and also the growth rate, if the corporation still have potential to grow. Right? So now talking about the expected return, all right, the R, which is also means the cost of equity. Remember, there are two parties that I illustrated before in class. Okay, we have institution and also investor. Okay, expected return is to the investor. All right, the percentage yield that an investor forecasts from a specific investment over a set period of time. Okay, what is the return that is expected? You already know where to get this expected return. You can do it by calculating the CAPM formula, and also from the stock price, the regression that you do for beta, and also the one that you do for your group project. Also, you can at least forecast the return, all right, over an investment, sometimes called market capitalization rate. So in terms of term, it can be used interchangeably. All right. Sometimes it was called expected return. Sometimes it was called market capitalization. Sometimes it was called discount rate, cost of capital. All right. But then you really need to read the question carefully. All right. And understand what does it mean by market capitalization in that question. Right? So to calculate expected return, all right, the R here, okay, given the information in the question saying that they give you dividend, they give you the price of year 1 and year 0, you can calculate the return. This is the one that you do in your group project. Remember, price at year 1, price at in the future year 1 minus the price the previous year divided by the price at the previous year. That is expected return. Alright, so dividend at year 1 plus price at year 1 minus price at year 0 divided by PO, which is price at year 0. This is like what you do for your group assignment. So that exercise is actually for you to find the return. Alright, what is the return? So this is one example. Okay, this particular company, okay, having a stock selling for 100 per share today. So their timeline is today, okay, is 100 ringgit, the price of that particular security, and is expected to sell for 110 1 year from now. Meaning to say next year it will be 110 ringgit. So what is the expected return if the dividend 1 year from now is forecasted to be $5? So $5 is next year or this year? Next year, right? So you use the calculation, okay? This one, to use this formula, you need to have a proxy of dividend for next year. All right? Not year 0, but next year. So read the question carefully. We can confuse you by putting in dividend at year 0 here. Okay, if it is dividend at year 0, you need to do some calculation whereby to find the value of this $5 in the future berapa. Right? So expected return $5 plus 110, which is the price that we sell off that investment, minus the price that is today, okay, which is 100 divided by 100, and we get the expected return of this particular security is at 15%, 0.15. All right. So one more thing, I think this is the correct time for me to explain. Okay, previously, when we do managerial finance, we do valuation in managerial finance, when we use the constant growth formula, okay, we are expected to hold that stock or investment forever because of the characteristic of corporation. Okay, a corporation will last forever, infinity. Betul tak? Right, always remember the characteristic of the corporation, all right, to do this valuation, because unlike the bond, okay, because there is a debt instrument, okay, borrowing kan, debt instrument, hutang, there is a time frame, a specific time frame. For example, for 5 years, 10 years, 15 years, 20 years, there is a specific time frame. But to value a common stock, okay, we don't have a time frame for that because of the assumption that the company will last forever. In future, there is no timeline. From where we are now, we can't see the future time that the corporations are going to be bankrupt or whatsoever. No. Alright? So in your managerial finance class, you have that assumption. Okay, you hold an investment, you hold a security, a stock of a company, and when you value it, we have the assumption that you will not do anything with that until you don't do anything with it forever lah. You just hold it. Alright, but for corporate finance, okay, we have a different assumption. Okay, Because, okay, our assumption here is when you hold or buy a security, at some point in time, you are going to sell it. Alright, you are going to sell it. Okay, you buy now, maybe not tomorrow, maybe a year from now or 2 years from now, you have the tendency, alright? You have the plan of selling it off. That's why we already know what is the price in the future. Right? That is why this happened. Okay, we have selling price. All right, makes sense? Previously, when you do your valuation in your managerial finance class, we don't have the assumption of buying and selling. No, we only have assumption you buy and you hold it and then you value the investment. All right? So that is different between the one that you learn in managerial finance and the one that we're going to learn in corporate finance. Okay, just a summary lah, in short lah. So that kalau saya cakap benda-benda yang lagi dalam, kalau you tak faham the concept, the summary of the different, it would be a bit difficult lah. So now you know, okay, now, okay, I have the expectation to sell in future. That's why you have the selling price in future. Right? So the price of any share of stock can be thought as the present value of future cash flow. So this is a normal calculation, okay, because we have the value in the future. So we want to find the price or the value of the stock. We only discount the value. All right. For a stock, the future cash flow are dividends and the ultimate sales price of the stock. Sales price. Remember, previously the only indicator that we need to value a stock is from dividends. Return on equity and also the growth. That's about it. We don't have any expectation that in future we're going to sell it off. But here we have the expectation of selling it off. That's why this is the formula. All right. So, it can be thought as this one as well. All right. So if we have this, if it's given the expected return, okay, you can use this formula to find the price. Alright, the same. Okay, the price of this particular security is still the same. Is year 0 at 100. Right? So, market capitalization rate can be estimated using the perpetuity formula. Alright, given minor algebraic manipulation, which is also called the cost of equity capital. So, if you look at this formula, it's actually a constant growth formula. Alright, P0, dividend at year 1, R minus 3. Alright, so this one as well, to use this formula as well, I need to do some illustration. Okay, kejap. Alright, this one, right? This is the constant growth formula. Okay, P0 equal to dividend at year 1. Okay, R minus growth. Alright, so now look at this formula. Okay, if you want to find a price at year 0, you need information of dividend at year 1, which is a year ahead. Alright, so it doesn't matter, okay, which point in time are you, okay? Sorry my handwriting is tak pernah cantik sorry, tak pernah cantik dekat lukis dekat whiteboard ke. Okay, and today I have bit of challenges, okay, because my Wacom is not working. Actually, usually when I do online teaching and I need to use a whiteboard to indicate to project the calculation, I use my Wacom. But from yesterday, I tried to reinstall because dah lama kan tak ada online class. I need to reinstall the Wacom, but it doesn't function. I'm not sure because of the computer or the Wacom itself. So, I need to use the mouse. Mouse dah. Kalau use mouse ni lagilah tak cantik kan. Alright. Just hope you just bear with me lah. Nampak macam mana kan? Alright. Now, this formula is saying that you need the information from dividend at year 1 here, okay? And then you discount the value at year 0, right? This is the information. But what happened, okay, if we want to find the price of year 1, okay, price at year 1. So what information do you need to use? Dividend. Is it the dividend at year 1 or dividend at year 2? Which one?
Year 2.
Year 2, yes, of course, because it's a year ahead. Because, yes, thank you. Thank you for responding. All right? Always remember this. No matter which point in time that you go. All right? And if you want to estimate the price of year 2, right? So, you need a proxy of dividend at year 3. Okay? Always remember. And now, because here, okay, you are actually at year number 2. Okay? And when you want, this is the price at year number 2. So, if you want to find a price at year 0 from year number 2, so what we do? Of course, you need a price of year 2. Alright? Discount it at 1 plus R by the power of 2. Because number 2 here, price at year 2 here is at timeline number 2. Alright? Always remember this. Always, I know that everybody know how to use the formula. Okay? Everybody don't have problem. But then when the question asks you, okay, now, okay, estimate the price at year 4. Alright? So, how to use the formula? I only know that the price at year 0, dividend at year 1. The concept are still the same. Alright? But then, when you estimate price at year 4, okay, we need to use the proxy of dividend from year 5. Alright? And remember, okay, if you want to calculate, okay, the exact price at time 0, you need to discount it again. To bring it again to time 0. Okay? Always refer to your timeline. So this is starting from this one. Right? So price at year 0, dividend at year 1, divided by R, okay, which is cost of equity capital and sometimes being called by market capitalization rate minus the G. Okay, previously from managerial finance class, okay, we give you the dividends, although that sometimes we confuse you a bit. Okay, we don't give you directly dividend at year 1. Sorry. But then we give you dividends at year 0, but we ask you to find dividend at year 1. Right? Macam ni kan? Alright, in timeline, year 1, year 2, year 3, 4, kan? Okay, it says that, okay, here is dividend at year 1 kan? Okay, but then we give the information dividend at year 0 is $1. Okay, yeah, $1. Okay, $1. Okay, what is dividend at year 1? Okay, then we give you growth rate. Okay, contohnya 5%. So how do you find dividend at year 1? Okay, just a simple calculation. Dividend at year 1 equal $1 multiplied by 1 plus 0.05. Okay, and then you have the dividends at year 1. Okay, this is actually 1 plus growth rate. Faham ke? Boleh catch up? Okay. This is simple actually, but just to confuse you kan. You already know everything. You already know how to find future value by imposing the compounding punya concept kan. But then when we give you the information, you did not think it through. Okay, you did not really look at the information given. You did not do the timeline. Okay, and then you did not see where you are. That's the problem. Okay, so then we know that this is the constant growth formula. Okay, but then if they ask you to find market capitalization rate ataupun rate expected return, so you just rearrange back the formula to get the R. Right? So we're going to use a dividend discounted model. Okay, computation of today's stock price, which states that the share value equals the present value of all expected future dividends. All right, and here, okay, note that we have PH. P means price. H means horizon for your investment. Meaning to say, if you look at this information, if you look at this formula, you will know that some point in time, okay, in the future, you're going to sell it at this price. Alright? So you look back at your timeline. Okay. Timeline. Okay, previously here. Okay, this is your timeline. 1, 2, 3, 4, 5, and so on lah, yeah. Okay. So now, if I give you dividends, okay, you can do the proxy. Use the proxy. Dividend, okay. Year 1 divided by R minus G. This one is dividend Hodohnya dividend saya kejap This one. Okay, dividend. Okay, dividend. But when you use this, we are actually saying that it will run forever. But from the question just now, okay, in the slide, okay, year 1, 2, 3, 4, 5. Okay, there are points in times that you're going to sell it off. Okay, we're going to sell it. Okay, and get the return lah from the investment. This is what this formula are saying. Okay, see the difference between the one that you learned previously in managerial finance and the one that you learn now with me in corporate finance. Alright, so later on, because the previous batch that I taught, okay, when they have difficulties in doing the exam, okay, then I look back at my teaching, okay, look back at the notes and find why the students are confused with the concept. Actually, because of the one thing lah, because of the assumption, because previously we don't have the assumption of selling. Okay, we only have buy and then hold. Now, okay, your trading strategy is you buy, but at some point in time in the future, you're going to sell it off. So how do you value? Alright, although it's a normal time value of money, which is using the discounting concept, but because the assumption is not clear, then you don't know how it would be, how do you value, alright, the information. So H here is the time horizon for investment in future, okay. Maybe at one point in time you sell off, right? Then you use this information. Right, so the modified formula is this one. This part here is the amount of dividend been received. Maybe the sum of dividend, maybe the first 5 years. And then when you sell it off, okay, you get the price of that particular security. Then you need to bring the price again to year 0. Alright, so you already estimate the selling price the year that you wanted to sell. For example, if you're going to sell off your stock at year number 5, you already know what is the price in year number 5. So you just impose the present value calculation and bring it back to year 0. Okay. For example, this example, okay, forecasted to pay 5 dividends at the end of year 1. This is information is given, okay, at the end of year 1, meaning to say this is the dividends at year 1. And 5 ringgit and 50 dividends at the end of year 2. At the end of the second year, the stock will be sold for 121 ringgit. If the discount rate is 15%, what is the price? So you put it in the formula. So this is a dividend. And so this is the dividend at year 2. At the same time, okay, after receiving the dividend, you sell off. Alright, and receive 121. And you wanted to bring this one back to time 0. So this is how you do it. Alright, so if you want to separate this part also can, tak ada masalah. $5.50 divided by 1 plus 0.15 by the power of 2 plus 1 to 1 divided by 1 plus 0.15 by the power of 2 as well, because this part here, 121, also be received at year number 2. Alright, it doesn't matter whether you combine it together like this or you want to do it separately. It's the same. The answer would be the same. Right? So, how about this one? Current forecasts are for XYZ company to pay dividend of $3, $3.24, and $3.50 over the next 3 years respectively. Okay, draw your timeline. At the end of the 3 years, you anticipate selling your stock at the market price of $94.48. What is the price of the stock given a 12% expected return? Right? You draw your timeline. Okay. Now, $3 first year, $3.24 second year, $3.50 for dividends, okay, plus you also sell off your stock at year number 3. So you put it this way, and then when you value it, you will find that your value, the price of that particular security should be priced at $75 or 75 ringgit. Right? So this is just a diagram showing that the present value of dividends are lower and lower, and then the present value of price. Of course, if the price in the future it's apa, further away in future, when you discount the value because of the concept times value of money, then the amount that you receive is going to be smaller and smaller. All right. So dividend yield, okay, is the function of dividends, and also the function of dividends and also the price. Okay, the expected return on a stock investment plus the expected growth in the dividends, similar to the capitalization rate. Okay, this is the capitalization rate, the R, right? So now how to find the dividend yield? Okay, we have one example here. Dividend yield is a function of dividend divided by the price. So dividend is at $1.68 per shares, divided by the 42.45 is the price. Alright, the selling price of these shares or stock. So we have the capitalization rate of 0.04. Right? So, now, dividend yield assume a growth rate. All right. So this part here, okay, we wanted to find the expected return or capitalization rate, okay, with the assumption of having a growth rate. This is the constant growth type of shares. So using this formula just now, okay, so you already know that when you rearrange the constant growth formula, okay, this is how it looks with the question just now. Kan, assuming growth rate of 6.1%, okay, you just plug in the number in the equation and you find the capitalization rate or expected return for this stock is at 0.1 or 10% lah, okay, more or less. Okay, so and this is how the equation ataupun formula looks like. Okay, your dividend yield formula, the value ataupun the price of the security formula, and if it's they ask you to find the capitalization rate ataupun expected return, you can rearrange this formula. Right? So the next one is finding the price of the security by using the proxy from earning per share, which is this one. All right, given in the question, the information about earning per share, then we can work on the price of the security. Previously, in your managerial finance class, when we asked you to calculate or find the price or value of a common stock, usually we don't give the proxy of earning per share. We give you information regarding dividends. We give you the information about the returns, expected return, and also the growth. But we never give you information about earning per share. Actually, from earning per share as well, you can calculate what is the price of a security. Right? So the dividend growth rate, okay, can also be derived from applying the return on equity to the percentage of earning flow back into operation. Okay, if you notice, I'm not too sure in your manager finance class, you being introduced with this formula or not. All right. So now, sometimes, okay, in the question, okay, we ask you to use the constant growth formula, but then we don't give you the proxy of growth. All right, we don't give you the information about the growth. So this is how you can go about and find the value of growth. So the information that you need to know, okay, to find the value of growth is the return on equity, which is ROE. All right, ROE, and the plowback ratio. What is the plowback ratio? Plowback ratio is coming from the earning of a corporation. All right, the earning after you have the operating activities, okay, and then you already settle whatever debt that you have a set of earning. So this earning can be used to distribute it out as dividend, or it can be used to reinvested back in the corporation. Right? Okay, some corporation are saying, I'm going to reinvest it back to the corporation 100%. So no more dividend payment. Some corporation might say that, no, I'm going to give everything to dividend. All right, we distribute out everything as dividend to the investor. But some corporation are saying, no, I'm going to equally divide 50% going to the investor as dividend, another 50% going to the company. Okay, reinvested back to the company. But then some says that no, only 60% going to dividend payment to the investor, 40% going back. All right, so the growth rate is depends on the plowback ratio and also return on equity. All right, so there is an example. Okay, oh, we're going back to this one later on. Okay, this formula we call this formula is sustainable growth rate. All right, so valuing a non-constant growth, okay, basically is the normal present value calculation. You discount the value. All right, non-constant growth. Usually when valuing a stock, there would be years, earlier years with non-constant. Sometimes the growth is higher, lower or higher, but then at certain point in time, the growth are going to be constant forever. So when the growth being constant forever, then that is the time when you impose the constant growth formula, right? So the PH here, all right, is where you start using the constant growth formula, like in this example. All right, Phoenix produced dividends in 3 conservative years. Okay, first year there's no dividend payment. Okay, second year we have 0.31 cent. Third year we have 0.65 cent. All right, and it says that dividend in year 4 is estimated to be 0.67 and should grow in perpetuity at 4%. Grow in perpetuity, we know that perpetuity means forever. All right, so we can say that this is a constant growth. Starting from year 4, all right, the dividend is constant forever. So how do you put in the timeline? Okay, year 0, year 1, year 2, year 3, year 4 is like this. Okay, this is you can actually kejap you can actually, because kejap this is your timeline. Okay, year 1, year 2, year 3, year 4. Kan? So this is 0, this is 0.31, 0.65, right? And here is given already 0.67. And it says that this growth will be constant forever. Okay, going back to the concept, okay, for a corporation, there's assumption is going forever, kan? The life of corporation is forever in the future, forever, ever after, right? So now, this is the normal calculation, okay, for me, okay, then you go about to start with, because the information given that the dividend starting from year number 4 will grow forever. So this dividend 0.67 will grow on forever. So you find the price of year 3 first. Okay. P3 is the same actually, but then they only put this part here confusing, okay, for the student. It's the same actually. It's equal to dividend at year 4. Okay. So this one is R minus G. Dividend at year 04 is given already. 67 divided by R is 0.1 kan minus 0.04. Okay. So this part here, okay, is at year number 3. So when you have this, okay, when you have this number here, so you need to bring it back to year number 0. So that's why you have this part here. Faham tak? Okay. How much is this worth actually? Okay. Let me see. 0.10 minus 0.04. 0.67 divided by 0.4. It's $11.17 dekat sini. Betul tak? Can you help me to calculate?
Betul.
Okay. So you bring back this one, okay, to year number 0. So you divided by the discount rate of 0.1 by the power of 3. Because this is where you start to discount the value, the horizon value. Right? For this one, okay, for 0.65 normal, okay, 0.1 normal way, this one is normal way. Just this part here is actually 2 component. This is the constant growth formula, and this part here is just a normal time value calculation, the single sum calculation. Can you follow the discussion? Okay, alright. So usually I receive a lot of question regarding this question lah. Okay, this part here for in the slide, this part here always have after lecture. Like even the following weeks that we finish this part here usually before the midterm break, and then the first week after midterm break, I always get this question. So it's better for me to just spill it off lah on what does it mean by this formula lah. It's actually the same thing. Right? So if a firm elect to pay a lower dividends and reinvest the fund, the stock price may increase because the future dividends might be higher. Right? If they pay dividends at lower here, meaning to say they have the potential to have a higher dividends in the future. Right? So payout ratio is the fraction of earning paid as dividend. This one is So the plowback ratio is the fraction of earning retained by the firm. The one that we see just now. Okay, the growth rate is ROE. Okay, return on equity multiply by the plowback. Okay, so this is the formula dekat sini. So this is example, okay, that you can use information of earning per share to calculate the price. So our company forecasted to pay $8.33 dividend next year, okay, which represent 100% of its earning. They did not do any plowback. So this will provide investor with 15% expected return. Instead, we decide to plowback 40%. So plowback 40%, meaning to say only 60% being distributed out as dividend lah, alright? So the firm current return on equity, okay, return on equity is 25%. What is the value of stock before and after the plowback decision? Alright, so how do you go about and tackle this question? Right? First is you find they wanted to know before and after the plowback decision. So if you read the question, there is no growth. right? There's no growth because the dividends, the earning here was 100% being plowed back to the corporation. There's no growth, right? So how do we value a no growth stock? So we just treat it as a perpetuity formula. All right, so we have the dividends, which is $3.33 divided by 0.15, which is 15% expected return here. So the price of that security without no growth is $55.53. But then, okay, the corporation decide to plow back 40%, all right, of its earnings. So only 60% distributed out, 40% being plowed back. All right. So now, when the corporation plow back some earning, we can assume that there is a growth potential. If not, why do they need extra money, right? So why do the firm need extra money? It must be something that they wanted to use with the extra money. So we assume that they are having a growth potential. So, but there is no growth potential, there is no growth information given in the question. We can calculate it because we already know how to calculate the sustainable. Mana tadi? We already know how to calculate this one, this one. Alright? We already know how to calculate the growth. So we're going to use the calculation, right? So this is how we do it. Growth is the function of ROE, return on equity, this one. Alright, 25% multiplied by 40% because 40% is the one that being plowed back to the company. So we have the growth rate of 10%. 0.1 is 10%, right? So now, okay, the price of that particular security is a function of dividend. Okay, because we have the growth, so we know that we are going to use the constant growth formula. So we have the dividends, okay, divided by the return on apa tu? Expected return minus the rate, the growth rate. Alright, so but then look here. This is dividend, $5. But then the dividend given here is $8.33. Why is this so? Alright. So when it is 100% dividends, 100% earning, okay, being plowed back to the organization, the dividend is at 8.33. Right? But then now, okay, plowback is 40%, okay? So 100% minus 40% is 60%, right? Alright? Only this amount will be distributed out. So what you do is multiply by 0.6. So do you have like $4, 4.99 something? Do you get that number?
Yes, madam. 4.998.
Thank you. Okay, so we can like it's almost $5 lah. So we take it as $5. So that's why we have this $5 here. Clear? Boleh? Tahu kenapa ada
Yes,
$5
madam.
here? Alright, okay. Right, so then we use the information, okay, $5 divided by, this one is given, right? 15% tadi expected return minus the growth rate that we computed earlier. So we know that with growth potential, the price of this security is at 100 ringgit. So you can see that if there is a growth potential and without a growth potential, how's the price will react? How the price different, right? This is what we can say about a corporation that having a lot more growth potential and the corporation that having less growth potential that is already mature. There is no more room to expand, right? So this is how we go about and do the calculation. Right. So now the difference between the two number, all right, with growth and without growth is what we call present value of growth opportunity. All right. If the no growth corporations are given a chance to grow, this is the amount that they're going to receive. All right. The difference between with growth and no growth is at 44 ringgit and 44 cent. Alright, so the difference between the two number, we call it present value of growth opportunity, PVGO. Right, so this is the information lah. Present value of growth opportunity, the net present value of the firm's future investment, sustainable growth rate, the growth rate that we calculated just now, a steady rate at which a firm can grow, flow back ratio multiplied by the return on equity. Right? So okay ke? We almost done. Almost a few slides more and then we are done. So that one is the calculation of the price of a stock using a proxy from dividend. Remember, I tell you just now, okay, that some corporation did not provide dividend, did not distribute any dividends. Usually, this is what a matured corporations are lah. Okay, there's no dividends. Okay, so or a corporations are still in a growth potential. Okay. So, valuing a business, okay, for a corporation that did not pay dividends, okay, the value of business or project is usually computed as the discounted value of the free cash flow. Alright, free cash flow. This is also the second strategy for valuation that you learn in your managerial finance. Okay, but then remember free cash flow. Okay, on how you go and estimate the free cash flow, you can use the one that we already learned in learning unit 4A. Alright, using the Excel, the information that you get from the income statement, you did the Excel, you calculated what is the the fixed asset requirement and also working capital requirement. Okay. So now, the way on how you value, okay, the way on how you value a stock that have no dividends, okay, is the same actually on how you value a stock that have dividends. Only the cash flow is different. If the stock with dividend, you use this part is dividend, right? But for the corporation that did not pay dividend, you use this free cash flow as the proxy of the cash flow lah. So free cash flow for year 1, year 2, year 3. And also we have the horizon value, which is the price. Okay, the value of that particular corporation in the future. Alright? Salah, bukan this one. This one yang patutnya saya bulatkan tadi. Right? The way you value is the same. Okay, this is how. Okay, present value of free cash flows, and then the value in the future you use the estimation of the price of the business in the future, and you value it at the time, at the current time. You bring it back to the current time. Right? So example, okay, given the cash flow for this particular corporation, calculate the present value of near-term cash flow, present value of horizon value, and the total value of the firm. Given the expected return of 10% and the growth is at 6%. Okay, so you do the calculation again, okay, and then you get the free cash flow of this amount. Okay, this amount. And then you look at the earning per share growth, okay, where is the earnings start to be stable ataupun constant. Alright, like in this example, okay, it says it start at year number 6. Right, number 6 here. Okay, number 6. So it start at year number 7, but then we need to go and calculate we need to calculate the horizon value starting from the year 7. Okay, it start having a constant growth, I would say lah. Okay, here, right, the constant growth here. So how you value it? We value we value the horizon value first. Okay, so this is the technique, the same technique as we did in the previous example. Okay, this is the free cash flow at 1.59 million maybe, divided by the return minus the growth 0.06, and you have the value of horizon value. And then the present value of the free cash flow, you have this normal one, discount it in the normal way using the one-off present value calculation. All right. Okay. And then what you do is you add them together. All right. Then you will know that the present value of the business. Right. The total of the present value of the free cash flow, okay, every year before the growth being constant, and then plus the present value of horizon value when the value of the corporation being constant given the growth of 6%. Okay, so now this one here, I need to go about and stress on this part here. Okay, now because we are valuing, okay, in this question they just ask you to value a business. All right, but in the business, usually the capital structure of the business is a combination between the equity and also the debt, right? So in terms of the cost of capital use here, okay, when you are saying about valuing a business, you have to know the sources of financing too, right? So if it's stated that the sources of financing is 100% from equity, then the cost of capital here is return on equity. But then if let's say the sources of financing is a mixture of debt and equity, so you need to calculate WACC. Okay, you already know how to calculate WACC kan? Kita dah belajar previously on how you calculate WACC. But for this question, right, for this question, they only give you, already give you directly. R is cost of capital. You don't need to think about whether it is coming from the equity ke, is coming from the debt ke. You just use the information as it is. So we assume, all right, here, okay, maybe they already computed the WACC. So you just use it. But always remember, okay, always remember when you value a business, check on whether it's 100% of equity, all right? Usually 100% of equity lah, okay? And if it's a mixture of financing, they will always indicate in the question, okay? The capital structure of the corporation is coming from the mixture of financing, then you know that you need to calculate the WACC. Alright? It's either 100% or mix. Dia tak pernah 100% of debt. Alright? 100% of the RD kan? So it is totally out of our discussion lah, because there is no such thing of 100% of debt capital structure. Okay, it's a private corporation if it's 100% of debt. We will go to that detail of the discussion when you come back from your midterm exam. When you come back from your midterm break later on. Right? So I think that's about it. Okay, that's about it for our discussion of valuation on common stock. Right? So we pretty much covered the basic thing. All right. It actually refreshing your what you know lah, your knowledge on how the constant growth formula. Okay, I believe that everybody know what is constant growth formula. Adding up some more new information regarding the timeline, okay, about the assumption used to value a common stock. Previous assumption is you hold the stock up to forever, but then in corporate finance, there are certain time in the future that you sell off your the stock, and because of this it changes a bit only. Okay, the basic is still the same, but it changes a bit on how you value the stock. All right, I think that's about and then the introduction of the growth. All right, how you estimate the growth, and also using the earning per share, all right, earning of corporation information to find the price of a security or the price of the stock. So that is the thing lah, simple, a very simple thing, but just apa tu, and deepen your understanding and deepen the concept that you already learned before in managerial finance. Okay ke semua? Any questions so far regarding this topic? Tak ada. Okay. So this one will be included as well in your exam tomorrow. Okay. So I'll be here lah. Okay. I'll be available when we start the exam. If you encounter any problem, do let me know as soon as possible. You can WhatsApp me personally, or you use our WhatsApp group for if you have anything that any trouble that you have, any problem that you encounter with that. All right. So yes, I think I would stop our class today here. Okay, so good luck for the exam tomorrow. Okay. I'll see you tomorrow then. Okay, so I'll see you in week number 8 when you come back to campus. Take care, everybody. Good luck.
Thank you, madam.
Thank you. I'm going to project back the QR for those yang tak dapat scan tadi. Alright. Okay, Daniel, you can leave your ID in the chat.
Thank you, madam.
Okay.